Hello and welcome to today's webinar. My name is Lisa Webster and I'm Senior Technical Consultant here at AJ Bell. We're approaching tax year end, so it's the time of year where it's important for clients to use allowances if they haven't done so already. So I thought it'd be a good time to talk about pensions and how much you can put into them. So starting off, I'll cover the basics about contributions, who can pay into pensions. We'll have a look at tax relief, how that works. The annual allowance, and then the last bit will be on sort of excess contributions, what happens if you put in too much and what you can and can't do about that. So starting off with the basics then. First thing really is who can pay into a pension, who can have a UK registered pension, who can be a member, and then who can put money into those pensions. So first one obviously is the member themselves. An individual can pay into their own pension. The next obvious one is their employer. Obviously very common, employers will be paying into pension for their employees. And then the third one really is anybody else. So from HMRC's point of view, there aren't any restrictions on who can pay into a pension scheme for the member. When we're looking at third-party contributions, we just need to consider, say, sort of anti-money laundering, make sure we can verify source of funds. But the basic rule is, anybody can pay into a pension. Now, of course, in practical terms, what you really want to know is, how much people can pay in. And that really comes down to the sort of two elements to it. So from one point of view is, from HMRC's point of view, there actually isn't a limit on how much you can put into a pension. You can put in whatever you want as a gross contribution. Obviously, in practical terms, what you really want to know, what your clients really want to know, is how much can you pay in and get tax relief on, and how much can you pay in and get tax relief on without being subject to the annual allowance charge, so within the annual allowance. So there are two different elements to this, and they can get confused, and they can be confusing. But yeah, tax relief and annual allowance are two separate things, two separate sort of processes, two things you need to think about, but obviously they do interact with each other. But as I say, HMRC technically would let you put in unlimited gross contributions. Not all providers will. For example, we won't accept non-relievable personal contributions. We only accept personal contributions that are which would qualify for tax relief on them. So looking at tax relief first of all, and member contributions to start with. So we're going to look at the who can make member contributions and how much can they put in. So the first thing, to have a contribution that is personal pension contribution that will qualify for tax relief, you have to be a relevant UK individual, a rookie. And to be a relevant UK individual, you just have to meet one of those four criteria that we've got there. So you have to have either have to have UK earnings, so earnings that are subject to income tax in the UK. Or you could be a UK resident, so you don't have to be earning anything. Obviously, this will count for things like we have junior SIPs. You can have pensions at any age. So yeah, children might not have UK earnings, but they could still be a UK resident, and therefore they could still have a pension and have relievable contributions go into them. We have Crown employees, so most common example is probably somebody in the armed forces who's stationed overseas. You may have diplomats, embassy staff, plus their spouse or civil partner. They also qualify as relevant UK individuals. And then somebody who's been resident in the UK in the previous 5 years when they joined the scheme. So that might be somebody who's lived in the UK for a period of time, maybe all their life, set up a pension scheme whilst they're in the UK, and then they've moved abroad. And if they've moved abroad, they're still counted as a relevant UK individual for the next 5 tax years after they've left. So they would still qualify. They have to be under 75. It's a fairly simple rule. Yeah, you can't get tax relief on member contributions past your 75th birthday. But if you are a relevant UK individual and you are under 75, then you can have tax relief on your personal contributions up to the higher of your relevant UK earnings and £3,600. So the £3,600, the basic amount, so that you'd actually pay in 2,880 net, and then you'd get tax relief of £720 to top it up to the 3,600. And you can get that even if you're not paying any tax at all, even if you don't have any earnings, as long as you're meets one of the other criteria. So if you're a UK resident, so this is probably the most obvious one. So like for children, for child SIPs, junior SIPs, or you can pay in for non-working spouses, things like that, for the 3,600. In terms of the relevant UK earnings, so most people it's going to be their employment income, salary, wages, inclusive bonus, overtime, commission, things like that, statutory sick pay, maternity pay, self-employed income, income from a trade or profession, if you're self-employed, or partnership, that would all count as relevant UK earnings. Things from patent rights, probably don't come across that one quite so much. Obviously, it doesn't include anything that's not taxable in the UK. It doesn't include things like dividends, dividend on shares, sorry, rental income, investment income doesn't count. Pension income doesn't count either, even though that is subject to UK income tax if it's pension payments. You can't use that as relevant earnings to then pay it back in again. They get tax relief second time round. So it's the higher of relevant UK earnings and the 3,600 that can be paid in as a personal contribution and get tax relief on it. If we are looking at third-party contributions, so this is somebody other than the member or their employer putting money into the pension, they are, for tax relief purposes, treated as though the member had paid them themselves. So maybe a spouse, or it might be a parent or grandparent for a child, makes a contribution for somebody. The person who's receiving that contribution into their pension has to meet the criteria, not the person who's actually physically making the contribution. So you could have a relative that lived overseas, wasn't a relevant UK individual, but they could still pay in to somebody who had a UK pension scheme, subject to being able to check for anti-money laundering requirements, etc., verify source of funds, that kind of thing. But yeah, the important thing is for the tax relief, the amount of the contribution, the individual who's receiving it has to have the relevant UK earnings, or you're down to this 3,600 limit for them to be able to receive that contribution into their pension. Also, if you have higher or additional rate taxpayers and they receive a contribution, obviously the basic rate relief will go into the scheme for them, but also the higher or additional rate relief will be received by the person who's received the pension contribution, not the person who's actually made the contribution. They don't get any tax relief on it at all. So it is treated as though it's the member doing it themselves for every purpose, really, apart from sort of the anti-money laundering aspect to it. So in terms of the process of getting tax relief on member contributions, so we have two main methods. We have relief at source and we have net pay. So under a net pay scheme, obviously these are only occupational schemes where the employer will deduct the contributions from pay before it is taxed, in which case, because you've never paid the tax on it, the tax relief is automatic. So if you're a higher or additional rate taxpayer, that makes it easier for you because you don't have to do anything. It's automatic and it goes into the pension before you've had tax deducted. So disadvantage for people who aren't paying tax, as has had a lot of press, and the government are meant to be looking at and trying to resolve, but it's not coming about for a couple of years yet, any of their solutions. But for people who I suppose who are more likely to have a financial advisor, more likely to be higher earners, then it is better because they get all the relief automatically. But for anybody paying into a relief at source scheme, which all personal pensions will be, so when the contribution comes in, it comes in net of basic rate tax. So if you want to have £10,000 in your pension scheme, you actually only pay in £8,000. We claim the 20% basic rate relief. So you end up with £10,000 in the scheme. that is the same for everybody. We always get the 20%, you know, regardless if, you know, it's 3,600 and they've got no earnings, regardless if you have clients who are resident north of the border and they may only be paying 19% tax in Scotland, and the rate up there, the starter rate of tax, they still get 20% on everything up to on their earnings on there when it goes in on a relief source scheme. However, what you do have to do, of course, is claim any extra relief under relief at source. So anybody who is paying more than 20% tax to get the extra relief on their pension contribution, you would normally do it under by self-assessment by filling in the relevant pages, section as shown here, on your self-assessment. You may be able to just phone HMRC and do it over the phone, or write to them that way. If you're additional rate taxpayer, you have to do it via self-assessment. And again, important, especially say for Scottish clients, if they're 21%, to get that extra 1% for on their rate. I think a lot of people don't claim that, could be missing out on it. So yeah, so when you claim the extra relief, this is the box here highlighted that you need to fill in, and it does say payments to registered pension schemes where basic rate tax relief will be claimed by your pension provider, called relief at source, enter the payment and basic rate tax. So what that means is if you physically paid in the £8,000, you get £2,000 basic rate relief in the scheme. So you end up with £10,000 in the scheme. £10,000 is the number that gets entered on the self-assessment to make sure you get the additional rate relief. It all gets worked out at the end of the year once you do the tax affairs. And tax relief will be given either by a change to your tax code for the following year. It could be a tax rebate, or it could be a reduction in the tax already due to HMRC. If you haven't done it if somebody hasn't done it for a year, they've missed it, not put it on the forms, you've done returns or whatever, you have got 4 years at the end of the tax year that you're claiming for, 4 years after that, to go back if you've missed any, and redo the self-assessment or contact HMRC and and make the claim for it. So you have got a couple of years to go back if necessary on that. So that's sort of member contributions, getting the tax relief, so partly in the scheme under relief at source, obviously, which all our pensions are. So you're 20% there, and you get your additional higher rate relief via self-assessment or contacting HMRC. Employer contributions work differently because they are paid gross into the pension scheme, and it is the company that gets the tax relief on them. So the company gets it's the company, it goes in their accounts, it's a legitimate business expense, and they get a reduction in their corporation tax bill for the year because it reduces the amount of their profits. In terms of sort of meeting the criteria to qualify for tax relief on it, it has to meet what's called the wholly and exclusively rules. So wholly and exclusively for the purposes of the trade of the business is the phrase that HMRC use, or an expense of management if it's an investment business. What that means is that the individual that the employer is making the contribution for has to be worth that amount to the business. They have to add that value to the business, and the contribution, and this includes like for directors as well, they have to be getting a package, a remuneration package that is, sort of similar to somebody else in the same position. So, what they're trying to avoid is somebody who has a spouse partner working in the business who actually, well, they're on the books, but they don't actually do anything, and then you get huge contributions going in for them for tax relief purposes going into pensions, but obviously that's not wholly and exclusively for the trade purposes of trade of the business. There's other reasons why people want to do that, so they wouldn't qualify for tax relief. If this was ever questioned, then it would be a conversation that went on between the local inspector of taxes and the company accountant, because it is the company, say, that is claiming the tax relief on it, claiming it as a business expense to reduce the corporation tax. It isn't anything to do with the pension itself. We, pension scheme administrator, trustee, we don't claim the tax relief on this, so that's not anything that we would be involved in. Now, I don't know that there's really that many of them that get queried. Obviously, the bigger the contribution you make, the more likely it is to be looked at. But yeah, if you can justify it as part of the remuneration package for the individual, and if there's similar people in the business at the same level who are getting a similar package, things like that will all help that argument. It's not restricted by earnings, so unlike obviously personal contributions, member contributions, which are, it's not unusual for especially sort of directors, management to take much smaller salaries but take higher pension contributions. That's absolutely fine as long as, say, the whole remuneration package looks right for that sort of level of, what the level that individual is in the business. That's fine on that one. Last point I've got there is that it's only the amount paid that is considered. Now, that might sound obvious, but what I mean by that is that you can't just put it in the company accounts 1 year as a debt that the company is going to make a pension contribution in the future. And for that, in that company year, to qualify for tax relief in that year, it can only qualify for tax relief to reduce the profits and therefore reduce the corporation tax for the company if it's actually physically been paid in that year. You can't just have it as a debt on the accounts. So yeah, it has to physically have been paid. So that's obviously quite important. Obviously we're talking, we're coming up to tax year end and using allowances, etc. Obviously for an employer, it's going to be the company year end that's important rather than the tax year end in terms of getting the tax relief. But we know obviously a lot of businesses will have 31st of March as their tax year end, so it might be approaching that time for them as well. And so sort of with that in mind, I'm going to have a quick look at dates of contributions about when they are classed as being paid, because we always have a few issues around tax year end. So if it just depends a little bit on the method of payment. So if you're going to be old school and use a cheque, send a cheque off to the scheme administrator, then that will be the date received by the scheme administrator is normally the deemed date of that contribution. If you're making a payment by card, the date those card payments and the details are given to the scheme administrator should be the same date as the contribution. Direct debit, date authorised to draw the sum from the bank account, as long as there's money in that account for it to clear. So they actually do come through. Faster payments, well, you have to be a little bit careful on, because faster payments, we're so used to these now and them being pretty much instantaneous. So looking at your account pretty much straight away, it's there. But there are no guarantees with that. Faster payments don't have a guarantee system in terms of time of payment in the way of some other methods. So we have seen issues. So tax year end issues, obviously we're talking about personal contributions, it is the tax year end that's relevant. If we're talking about employer contributions, to say it'll be company year end, that's the relevant factor. First one here, we have had this happened a couple of years ago. We've had ones like this where the cheque's not been honoured. So we've received the cheque, and normally on the date we receive the cheque, that would be the date of the contribution. But if we then send it off to the bank and the bank for whatever reason don't honour it, we've had ones where it's been things like they've queried the signature, so the signature doesn't match. And then there's obviously been something going on behind the scenes and they've resolved that, but it's had to be represented. But if it's gone over the tax year end by that point, even though we've originally received the cheque in the previous tax year, we can't backdate it. So, these are things we've spoken to HMRC about, and there's no leeway on them. They wouldn't let us do it, even though you can see those circumstances where, we've had it. And it has eventually, cleared, but because of that delay, that's caused problems. Direct debits, if it's failed when it's first come through because of lack of funds, and then when it's tried to do it again, it has gone through, but it's crossed over a tax year end, then obviously it's still going to be it's going to be in the new tax year if that happens. This one here, we have a tax direct debit due on or before 5th of April, but then holidays and bank holidays, it can still be classed as the earlier tax year if it's the first working day. That's probably not so much of an issue this year, as we have a midweek new tax year, or tax year end new tax year, so that's probably not too much of a problem this year. Faster payments, sort of as I touched on already, we can have too high expectations with these, that is the same day, but that isn't always the case. And again, we have had cases with this where people have expected it to be the same day and it's just not gone through. And HMRC are sort of quite clear that that's not a reason, and they're not going to backdate it. If it hasn't come through, it hasn't come through, and it's just tough. So really, you know, the moral of the story is don't leave it to tax year end, but I think you probably all know that already. But we always get people, we also get things obviously coming through at the last minute every year. Always happens, but try and avoid it wherever possible, and don't leave things to the last minute. So that's sort of, you know, looking at tax relief. And I suppose another thing that also affects it about the date of payments, obviously when you're talking about member contributions, your earnings, makes a difference which tax year it's in for that purpose as well. So the other part of this, sort of the other half of the equation, if you like, in terms of how much you can put in, is about annual allowance. So first question basically is, what is the annual allowance? So in simple terms, the annual allowance is the maximum amount of pension savings an individual can make each year with the benefit of tax relief. So your annual allowance covers all your personal contributions, all your employer contributions. If you do have any third-party contributions, they're included as well, and across all pension schemes. So it's the sum of everything, every pension contribution that's gone in the tax year relevant to that individual. And it's a maximum amount that they can get tax relief on, that can benefit tax relief, but it isn't a restriction on the amount of tax relief given out when the pension savings are made. So this is where it gets a bit confusing. So it doesn't stop your ability to get tax relief. You can still, if you have £500,000 of earnings, you can put £500,000 in to your pension, or you put £400,000 into a relief at source scheme, get your basic rate tax relief on it to £500,000, and you can get all that tax relief on it. It doesn't restrict it. They say it's restricted by earnings, personal contributions, your employer, it's your wholly and exclusively rules for the employer getting the tax relief on it. The annual allowance doesn't change any of that, but what it does do is apply a tax charge if you exceed the annual allowance. So I say it's really important you still claim the tax relief even if you have an annual allowance charge, because you get the annual allowance charge if you've exceeded the annual allowance regardless, so you at least want to make sure you get the tax relief first that sort of offsets the annual allowance charge. Of course, we don't just have one annual allowance, we now actually have 4 plus carry forward. So when annual allowance started, back with A-Day, we just had 1, but now we have obviously grown and things have got more and more complicated. So we still have the main annual allowance of £40,000. We now have the money purchase annual allowance of £4,000. We have a tapered annual allowance, which can be anything between £4,000 and just under £40,000, £39,999. And we have an alternative annual allowance of up to £36,000, probably the lesser known one. And on top of that, we have carry forward, which you can use with some allowances, but not all of them. So I'll have a little look at sort of each of those in turn. So standard annual allowance first. So this came in at A-Day back in 2006, and it was set out initially, the first 5 years were set out in legislation, and we knew what the annual allowance was going to be, and we knew that it was going to go up every year. And it was actually set in legislation, Finance Act 2004, that the annual allowance can go down. Obviously, we know that legislation can be changed. So yeah, we had the big drop in 2011-12, where we went from sort of the 255 down to 50,000. And at that point in time, carry forward was introduced. We didn't used to have it, you didn't really need it because the amounts were so high previously. So we had this concept of carry forward that came in. We then had another event, if you like, in 2014-15, we had a slight reduction down to 40,000, but then 15-16, we had when the PIPs were aligned, so we had a bit of a funny year then in terms of pension contributions. So pension input periods, PIPs. We used to be able to have pension input periods, which was like the period over which the amount of pension savings under an arrangement were measured. You used to be able to change them, so they couldn't be more than 1 year, but they could be shortened if you needed to, which meant in practice you could sort of use 2 years allowances in one tax year. It did make things more complicated, so I'm probably a fan of at least a little bit of simplification. The fact is now we don't have to worry about pension input periods anymore. This is always now aligned with the tax year. But so people weren't sort of penalised retrospectively, and people who'd already done this sort of moving them around and maybe sort of made effectively like 2 contributions in 1 year. That's why we had this funny bit where we had 80,000 in 2015-16 for what was called the pre-alignment period, and then nothing but the ability to carry over in the post-alignment period. Thankfully, that's sort of dropped away now, and it's a straightforward £40,000 a year. And that hasn't changed for some time, and it's, you know, it's frozen again next year. It's not due to change come April. So this is obviously our standard that we have now, £40,000 annual allowance, which will affect the majority of people. This will be their annual allowance, but they also have this ability to use carry forward. So a few things just to remember when we talk about carry forward is that it is the allowance that you are carrying forward, not the tax relief. Those of you that are old enough to have been in the business before 2006, we had a different type of carry forward and carry back, and that used to involve tax relief, so that's long gone now. It is always the allowance, the unused allowance, that is carried forward. And you can carry forward from the last 3 tax years as long as you were a member of a UK registered pension scheme in that tax year. You don't have to be an active member. You can be a deferred member or a pensioner member. That is fine. Gets a bit funny around annuities. If the annuity is purchased by the pension scheme, then that's fine, you count as a member. But if you've got an annuity in your own name, that's not actually a registered pension scheme, then that doesn't count for the purposes of being able to use carry forward if that's all the member had. Fairly unusual one where that was the case, so they still wanted to make contributions, but it does crop up from time to time. So yeah, deferred member, active or pensioner member, basically, in the year from which they are carrying forward from. You always use this year's allowance first, and then you go back to the oldest unused allowance. So you will go back this year. Furthest you'll go back is 2018-19. So, and if you have got clients with unused allowance from 18-19, then this is the last chance to use it before the end of this tax year, because otherwise it'll drop off. And if it's not been used, then it's gone, gone forever. A couple of examples then on sort of carry forward and sort of how it works and what you can and can't do on it. So Janet, first of all, we have Janet, who has just got a deferred pension. She's not made any contributions in the past 5 years. She's been abroad, had no UK relevant earnings. So she was working, living in the UK, set up a pension scheme, paying into it. She then moved abroad for 5 years. Hasn't paid anything in while she's been abroad, didn't have any UK relevant earnings in those years. She's now moved back, and this year she has had £200,000 UK relevant earnings. So the question there is, what is the maximum personal contribution she can make without having an annual allowance charge? So first of all is this year. So this year she's got 40,000 annual allowance because she's not used any. You go back then sort of 3 years ago, use a carry forward. Was she a member of a pension scheme? Yes, she was. She had a deferred pension the whole time. In fact, she hasn't paid into it. She wasn't in the country. Doesn't matter. At the time she's making the contribution, you know, she's a relevant UK individual. She has UK relevant earnings. So she can actually use this year's annual allowance, and she's got 3 years carry forward as well. So she could put in £160,000. So she can make quite a sizable contribution without exceeding her annual allowance. We also know, yes, she's got 200,000 UK relevant earnings this year. She's not going to be over the limit for the tapered annual allowance, which I'll come and talk a bit more about that in a minute. But she's not over the limit for this year, so she doesn't have to worry about it. And we know in the previous years, she doesn't have to, she didn't have any UK earnings, so she wouldn't have been hit by it in the past either, the past few years for that to impact her. So she's fine, she can put in, let's say, £160,000. Over here we have John now, and John has a deferred pension only. Again, he hasn't made any contributions in the 5 years. He has been in the UK, he's just not been paying into his pension. He only earns £35,000 a year, which he has had for the last 5 years. He suddenly comes into some money, so he inherits £200,000. So he wants to now try and make up for some lost time on his pension contributions, put in the most he can without having an annual allowance charge. Now, we look at this, and in terms of annual allowance, yes, he's got lots of annual allowance available this year, and he would have carry forward available. But actually, it's irrelevant for John, because you can only, in personal contributions, you can only put in up to 100% of your UK relevant earnings, which is £35,000. So carry forward, to say, is irrelevant to him. You have to have the earnings first to be able to get the tax relief on it before you start worrying about the annual allowance. Right, turning now to everybody's favourite subject, the tapered annual allowance. So the rules on the tapered annual allowance changed for the start of the 2021 tax year, and the limits changed on it. So it was introduced 2016-17, and we had the same limits up to 19-20 inclusive. The actual sort of the concept of it, the process of how you calculate it, what's included in the definitions of income, anything like that, hasn't changed. It's just those limits that have moved. So it is still really complicated and horrible, but less people will be impacted by it from last tax year going forward. You can use carry forward for people that are tapered, and you will carry forward the tapered, whatever they've got left over from their tapered annual allowance. That's the amount that can be carried forward. So you may well still have to worry about the old rules if you're looking at people that if they have unused allowance, which may be a tapered annual allowance from 18-19 or 19-20, then you would still have to calculate it under the old rules to work out what they can put in this year and going forward on that. So say different thresholds, same concept. So, but basically for individuals that have income, and we'll go into sort of more of a definition of what I mean by income, but basically it's income from all sources, so it's investment income and earned income. If people have income of below 110,000 under the old rules, or under 200,000 last tax year or this tax year, then you don't have to worry about the tapered annual allowance. That is the good news on those ones. People that are in this sort of middle band here, so under the old rules between 110 and 150, and under the new ones between 200 and 240,000, then they may be impacted by the taper. There may also be action you can take to make sure that they're not, because this is sort of a category where, depending on how you manage the contributions, splitting between personal and employer contributions, you may be able to get them below the lower threshold by using personal contributions to take them out of the taper. But then there's people whose earnings are over 150,000 under the old rules, not earnings, I should say income, because it's not, it's investment income as well, not just earnings, or over 240,000 now, then they are going to be impacted by the taper and have a reduction in the amount they can put into their pension without having the annual allowance charge. So that's sort of like the basics of who you need to worry about or not on it. We have these two definitions, which I'll look at in more detail in a moment. We have adjusted income. So the rule is basically, if your adjusted income is above £150,000 previously, 240,000 now, and the threshold income is above 110,000 or 200,000, then you are impacted by the taper. So two limits, both have to apply for the taper to apply. If the taper does apply, then there is a minimum amount which can be reduced down to, which under the old rules was 10,000, under the new rules is 4,000. So if both your adjusted and threshold income are above the relevant limit, then the annual allowance is reduced by £1 for every £2 of income above the adjusted income limit, which is the higher limit, subject to the minimum. So what it meant under the old rules, anybody who had income above £210,000 under the old rules, they would be subject to the maximum taper. So their tapered annual allowance would be 10,000. Obviously, somebody whose income was between 150 and 210, the taper would be somewhere in between 10 and 40,000, depending on what their income was. Under the new rules, the maximum taper applies to anybody with income above, adjusted income above £312,000, and that gets tapered all the way down to 4,000. So there'll be a lot more people who are better off under the new rules because they've been taken out of the taper completely, or the reduction is less. But there are a small amount of people right at the top end who are actually going to be worse off because the maximum taper is bigger, so the minimum reduced annual allowance is lower, 4,000 rather than 10,000. In terms of sort of how you calculate the adjusted and threshold income, the starting point for both is net income. Well, now that is your total income for the year, and then it's net of sort of any reliefs due. It's under section 24 of the Income Tax Act 2007, which is sort of normally things to do with sort of people who are trading, self-employment, things like that. So somebody who's employed, they're not likely to have any of those reliefs on it. Mainly we said the main relates to trading. We seem to sometimes get about gifts. Gift aid doesn't reduce your net income. It's only gifts of shares to charities that are included in that reduction. The income includes earnings from employment, earnings from self-employment, partnerships, pension income, including state pensions, occupational personal pensions, interest on savings, dividend income, rental income, income received from trusts. You know, pretty much most income is going to be included in this definition up here that we start off with for net income. When it comes to adjusted income then, so this is for the higher threshold, you have to add in what I've called employer facilitated contributions. So that is obviously employer contributions. It'll be net pay and salary sacrifice, because if you have net pay contributions or salary sacrifice contributions, they're going to reduce the net income up here because you have less income to start with. If you sacrifice some of your salary, obviously net pay has come out before it's been taxed. So you add them back in here as well as any other employer contributions. So that is all included in that definition of adjusted income. The only deduction you make on the adjusted income is a fairly rare one. You know, it's one you need to be aware of. It's not something that happens very often. It's a deduction for lump sum death benefit receipts chargeable to tax. So that would be is if the individual is a beneficiary of somebody else's pension, they've died over 75, and they've chosen to take those death benefits as a lump sum rather than as an income, as a beneficiary's drawdown. So not particularly common, but you know, it is in there on that. So this is your adjusted income. So this includes, say, all your employer contributions, and you can't reduce it through salary sacrifice or net pay because they're going to be added back in again. So you can't reduce your adjusted income really, and I say employer contributions will make it higher. Over on this side, your threshold income. So you start off with the same definition, starting point of your net income. You add in salary exchange agreements established after 9th of July 15, which was the date the tapered annual allowance was introduced, was announced. So obviously that's an anti-forestalling measure, anti-avoidance measure. So any new arrangements put in place, and that includes sort of flexible remuneration arrangements, either for the individual or for family members or dependents or etc. So you couldn't have, so you know, a husband or wife and he does salary sacrifice, so his wife gets benefit, things like that, or sort of vice versa. That doesn't work. If you had salary sacrifice agreements in place before the announcement, before July 15, they could continue, and that would be fine. You wouldn't have to add those back into your definition of threshold income. Importantly, though, on the threshold, the big sort of difference here is you can deduct personal contributions, and then the deduction at the bottom is the same as on adjusted. So what this means is, and this is sort of people whose starting point of net income falls between the range of 110 and the 150, or the 200 and the 240 under the new rules, between the threshold and adjusted income limits, that you can actually use personal contributions to get below the threshold. And if you get the threshold income below, say for this tax year, below £200,000, if you've not exceeded it, then you don't have to worry about the tapered annual allowance. So by maybe making personal contributions to get below the threshold, it might actually allow you to make a bigger employer contribution because you're not tapered. So there is some things that you can do, sort of planning around it for those people that are in that middle bracket where their starting point of net income is between the two thresholds. So that's sort of maybe the biggest point for planning, and where you can help people avoid the taper. Right, moving away from taper now on to the money purchase annual allowance, the MPAA. So this is obviously triggered when somebody takes flexible benefits. So taking income under flexi access drawdown, taking a UFPLS, uncrystallised fund pension lump sum, if you have a short-term annuity, a flexible annuity, any of those will trigger the money purchase annual allowance. Taking tax-free cash, pension commensurate lump sum only, or taking a lifetime annuity does not trigger it. And if you have people that started capped drawdown prior to 2006 of April 15 and have continued in it, taking income under that doesn't trigger it either. Another couple of funny ones, not always as commonly known, beneficiaries drawdown. If you have death benefits, it's beneficiaries drawdown, taking income under that doesn't trigger the money purchase annual allowance. And if somebody gets divorced and they have a disqualifying pension credit, and they take income as well, then that doesn't always trigger the money purchase. If it's not a disqualifying pension credit, it doesn't trigger the money purchase annual allowance as well. So there's a few other funny little quirky ones, but basically for most people it's going to be flexi access. It's triggered when you take flexi access drawdown, UFPLS, are the main ones on that. Once you've triggered it and once you've taken that income, then your annual allowance will be £4,000 for money purchase schemes. So if you have somebody who triggers it, but they also are still accruing DB benefit, that's fine. It doesn't impact their DB accrual. It is just for money purchase schemes. And you can't use carry forward for money purchase once the MPAA is triggered. So taper, you find you can still use carry forward under a tapered annual allowance. It'll be the tapered amounts carry forward, but MPAA, it stops it, say apart from the DB schemes, but for all your money purchase contributions, yeah, it's triggered. So what happens, a quick look at what happens in the year of the trigger. So obviously once you've triggered it in the previous tax year, going forward, you just have the £4,000 allowance a year. But let's look at somebody who's triggered it in the current tax year. So they started the tax year, they had a full annual allowance before they started taking benefits flexibly, before they started taking income. So they made some contributions there. Maybe they put in £3,000 before the trigger. 1st of October, they start taking some income under flexi access drawdown. The period from when they've done the trigger until the end of the tax year, that's when the MPAA applies. So they can still contribute £4,000 post trigger. And the tests that are done in that year is they have the full 40,000 for the entire year. So in this case, £34,000 will be tested against the 40,000 AA. And then they have the bit that's happened after the trigger is also tested against the money purchase annual allowance. So that's £4,000. They've maxed on that one, so that's fine. So in this case, they wouldn't have any annual allowance charge, but there's two separate tests that have taken place. But let's say from next tax year forward, it would just be the £4,000. Looking at the alternative annual allowance, the last of the annual allowances and probably the lesser known of them. So this is normally £36,000. So this is where somebody has both DB and DC schemes. They have accessed their DC, they've triggered the MPAA, so they have £4,000 money purchase annual allowance. But then they also have this alternative annual allowance of additional £36,000, which applies just to their DB schemes only. And it's only, you know, they've still got the 4,000. So it's only when the MPA is triggered and exceeded. So otherwise they could just put 40,000 in the DB if they didn't put anything into the other. That would be absolutely fine. You can, if you get really, really horrible, complicated cases, it is possible to have somebody who's triggered the MPAA and is also tapered, and one hand has DB accrual, in which case they could have a tapered alternative annual allowance if they've paid it, triggered the MPAA, paid into a scheme, exceeded the MPAA, then DB accrual. If you have one of those horrible ones, then you might, you know, want to speak to us or something, because it's quite a complicated interaction. It doesn't happen very often, but just sort of to be aware of. You can use carry forward as well in relation to the alternative annual allowance, even though you can't use, the same individual can't use carry forward in relation to the money purchase. They can use it, the alternative annual allowance, for the DB schemes. Okay, hopefully we don't have too many of those. Finally, I'm just going to have a little talk about excess contributions. So excess contributions, paying too much into a pension. What do we mean by that? And most importantly, what do HMRC mean by that? From a HMRC point of view, the only thing they deem an excess contribution is a personal contribution in excess of relevant UK earnings. So this is where somebody puts in more into their pension scheme than they're entitled to tax relief on it. So you have to be above the 3,600, sorry, and exceeded your earnings, because sort of right at the start we said the maximum for a member to make a contribution is the higher of UK relevant earnings, or 3,600. So it's only when that is exceeded. So this can happen, you know, people who are being organised at the start of the year, putting bigger contributions in, that the circumstances change, they lose the job or something halfway through the year, or most commonly with self-employed, because they don't know what their earnings are until after the tax year is finished. Obviously, you know, ideally you don't put it in the first place, but we know circumstances are, you know, it can happen. Circumstances change, so they have put in an excess contribution. Now, normally you would only get these refunded, the excess refunded after the end of the tax year, because of the point that you don't know. How do you know how much to refund? Because you don't know what your earnings are until the tax year has ended. You can't say for certain. But, you know, HMRC aren't actually that 100% strict on that one. There may be ones where people have had zero earnings, you know, they've just gone over it, and it's going to be down to the 3.6, and they're sort of fairly confident on that. But yeah, quite often it's better to wait till after the end of the tax year, especially for those self-employed, fluctuating earnings, once you actually know, and then do the refund. Now, it does have to be refunded. The tax relief has to go back to HMRC, because you're not entitled to it. You know, if you haven't had the earnings, let's say if somebody's had no earnings, you'd refund down to the 3,600, assuming they're still a relevant UK individual. But the excess has to go back to HMRC. And we have this 90-day deadline for the situation to be corrected, which is when it comes to light, basically, when we're aware of it. It's not 90 days from the date that the contribution went in. So, for example, if somebody had put a contribution in at the start of the tax year and in anticipation of earnings for the year, gets to the end of the year, for whatever reason they haven't earned it, the 90 days obviously would be long past from the date of the contribution. You know, that circumstance is going to be at least 90 days from the end of the tax year, but it might not come to light till a little bit afterwards. So 90 days from when it comes to light. After that, interest can be charged on it by HMRC. You know, if it takes longer than that for them to get their tax relief back. So HMRC rules, that is the only kind of excess contribution. Obviously, generally, once you've paid money into a pension scheme, you can't get it back. You have to wait until you're eligible to take benefits to be able to extract the money. Yeah, so excess contributions is really just in excess of relevant earnings. Obviously, there are plenty of other circumstances where we do get asked about getting contributions back, getting money back out of pension. HMRC do give us a bit of guidance in terms of what they call a genuine error. And what they say is, what they class as a genuine error is beyond the control of the person making an inadvertent payment to the scheme. So they include, the examples they give is where the member has been paying by direct debit, they tell their bank to cancel it, but the bank failed to act on it. Now, they would only accept that as a genuine error and allow us to refund that contribution, provided we had the evidence that that the instruction was given in good time. If the member sent it late, then that wouldn't count. We wouldn't be able to refund it. It would, and if we refunded where it didn't meet the genuine error rules, then it could be classed as an unauthorised payment and have lots of horrible tax charges on it. Browser error causing duplication. Yeah, we get payments come through twice. That might be, there's an example. With those, it's always better to have them, as quickly as possible, because if people notice that, they tend to notice it straight away, notify straight away. And there is a time element to these as well, where if people tell us straight away that an error has happened as soon as it's occurred, and you can see that's more likely to be a genuine error than if somebody makes a payment and then tells us about it several months later. It's like, I'm sure you just want your money back for a different reason than it being a genuine error. Sometimes we get ones like employer contributions where it's been mixed up. With those ones, we intend to, because there's still an intention to make a contribution, we can amend that rather than refund it. If it's gone down as a personal contribution and we've claimed tax relief and it should have been an employer contribution, then we could return the tax relief to HMRC, but not the whole contribution. Ones we get asked about a lot are exceeding the annual allowance. Exceeding the annual allowance, HMRC are very clear on that is not a reason for contribution refund. It's quite clear at the time the intention was to make a contribution. Member intended to make a contribution. Just because you've exceeded the annual allowance, that that doesn't alter that intention to make a contribution. Similarly, advisor error. If something's happened and you've advised, a client has been advised to make a contribution, and then for a wrong amount for whatever reason, and then the individual can't go, well, my advisor told me to do it, therefore I didn't mean to do it. That doesn't work either in terms of HMRC. And broken protection. Broken protection is a horrible one. It could be a very small contribution that can cost an awful lot of money. If protection is broken by making a contribution when somebody who's got enhanced protection or fixed protection, it could be an expensive mistake. But HMRC are very clear on it that isn't grounds for a refund. And with protection one, even if you did refund it, which would be an unauthorised payment, it wouldn't still alter the fact that the protection had already been broken, the contribution had been made. So yeah, so it's very limited the circumstances where we can make a contribution refund. I say the excess contribution, if it's above earnings for the year, is quite straightforward, but genuine error, they have to show the intent that there was never meant to be a pension contribution. It was never intended to go into the pension at all. So yeah, that is quite difficult. But also, the rules changed on this sort of a year or so ago, that we now have to report all refunds to HMRC. That didn't used to be the case, but now every time we make a contribution refund for whatever reason, we have to report it. So it is more likely to be looked at because HMRC have full visibility of it. So if they see that a pension scheme administrator is suddenly making lots of contribution refunds, they might start asking a few questions and looking into it. So yeah, our hands are quite tied in terms of what we can and cannot do when it comes to contribution refunds. So as I've said there, exceeding the annual allowance is not grounds for a refund. So if you exceed the annual allowance, you will get an annual allowance charge. And what it does, it basically reduces the tax relief received on the pension savings above the applicable annual allowance, whichever one that is. And the amount of excess over the annual allowance is then, what's called the chargeable amount, is added to taxable income for the year and then income tax applied. So it's not a set rate, it'll be whatever rate applies. It might cross different bands, different income tax bands, so it gets added to income for the year. So what this means is if someone's made a personal contribution that's tipped them over the annual allowance, they need to claim the tax relief on it first and foremost, as I say, relief at source, by your self-assessment. If you're a higher additional rate taxpayer, claim the extra relief, and then when you have an annual allowance charge, the annual allowance will effectively cancel out that extra relief that you've had on the bit that's over the annual allowance. If it's an employer contribution that's tipped you over the annual allowance, then obviously the employer, it doesn't make any difference to the employer whatsoever in terms of them being able to get tax relief, reduce their corporation tax bill. That is unchanged by the individual getting an annual allowance charge. So in those circumstances, the company can get the tax relief still, the member might get the annual allowance charge. But of course, you know, if they've had, it might still be worth them getting it because, you know, obviously they've had free money, if you like, from their employer, which a bit of which they pay a tax charge on. So they're paying a tax charge on something rather than not having anything at all. It could be preferable. It depends on the circumstances. Obviously, if you knew they were going to get an annual allowance charge, you may look at different ways they could have, rather than a pension contribution. Could they have it as additional pay? Could they have it, you know, in some other form where they didn't get a tax charge? But it'll depend on the circumstances on that one. At the bottom of here, I've just put this help sheet 345. That is the form which talks you through how to deal with an annual allowance charge. It's got calculation tools on there. It's got a link to the annual allowance calculator, HMRC's tool, which I have had some issues with in the past, but is meant to be working again now. And it tells you about sort of how to fill it in on the self-assessment. It's on the additional pages, what you need to complete on there about the annual allowance charge and the figures, and helps you calculate the figures to put on there. If somebody has sufficient carry forward, so they're not going to have an annual allowance charge, there is nowhere that you need to report that. We do get asked that, and, you know, where do you put it on the self-assessment? You know, if they've made a contribution of £100,000, but they've got enough carry forward, that's fine. There's no tax charges. Where do I put it? How do I claim the carry forward? You don't, is the simple answer. You don't have to put it on there. You only have to, you would still claim the tax relief as normal on the section that I showed earlier, on the self-assessment, but you don't have to put it, which this help sheet explains that if you have sufficient carry forward, you don't need to report it on there under the annual allowance charge section. But for those that do have a charge, then you may have the option of scheme pays. So obviously the individual can just pay the annual allowance charge themselves. That's absolutely fine. They may have the option of it coming from their pension scheme. So there's two types of scheme pays and voluntary scheme pays. So sort of the full scheme pays, if you like, the one on the left here. This scheme pays here only applies when the annual allowance charge has been exceeded in the particular scheme you're asking to pay it. And by that, I mean the 40,000 annual allowance charge must have been exceeded in one scheme. The amount of your annual allowance charge has to be at over £2,000. If you meet those criteria and you notify the scheme by the deadline, which is 31st of July, the year following the year in which the tax charge relates. So if somebody wants to pay an annual allowance charge for 2021, they would have to tell the scheme no later than 31st of July 22. If they meet those criteria, then the scheme has to pay it. It's compulsory scheme pays, and the scheme administrator is jointly liable with the member for paying that scheme, that annual allowance charge, sorry. So that's compulsory scheme pays. On the other side, we have voluntary scheme pays, which, so as the name suggests, it is voluntary, so schemes do not have to offer this. You won't get this from every pension scheme. Sort of DB occupational schemes might not do it, but any charge may be paid. So this will cover, people who've exceeded the MPAA. Most commonly, the ones that we see are the people that have exceeded their tapered annual allowance. So it doesn't have to be 40,000 exceeded. It could just be the tapered. There's no minimum amount for the annual allowance charge. It can be any amount. It can also have been the annual allowance charge could have arisen due to contributions to schemes elsewhere. So what I mean for that, by that, you may have made contributions to another scheme and then want to pay. Voluntary scheme pays to pay it from your invest centre SIP, your client's invest centre SIP. We do allow that. We do allow it even if the charge arises elsewhere. Most commonly it might be, if you've got a DB scheme and the DB accrual has triggered, so particularly it's tapered, a charge, and if that scheme won't pay it, but they've also got, if they had to sit with us, so they wanted to pay it out of the SIP rather than, it's quite complicated on the DB stuff, and the reductions and things. So it is voluntary. Obviously, the scheme doesn't have to do it. The scheme doesn't have any liability for it either. So the liability for it does remain with the member. Payment should be made by the self-assessment deadline to avoid late payments, but can be paid later. So there isn't as hard deadline like there is with compulsory scheme pays. In theory, you can ask us to do it at any time, but there is a risk because the charge is due by normal, self-assessment deadlines. If you don't pay it by that time, that you could have late payment charges. And as I've already covered, we can choose whether to allow the payment. We do allow it from all our schemes. We do voluntary scheme pays from our schemes. So just the point about the deadlines to avoid late penalties. The deadlines might be a little bit earlier than you think because the way that schemes pay the charges over to HMRC. So we have to do our accounting for tax return, which is a quarterly return. And so for each quarter, we have a deadline where it has to be filed by. Now, normally your self-assessment deadline is going to be the 31st of January. So if you need to guarantee that the payment is made by the scheme to HMRC by the 31st of January, so you don't have a late payment charge, you actually need to do it in this period here. So the scheme needs to know about it and take the payment, deduct it from the account, ready to pay across to HMRC by the 30th of September. Because if you leave it even till this quarter ending 31st of December, it's not guaranteed to get to HMRC to 14th of February. Now, I know this year there was an extension on self-assessment, so actually this year you would have been all right with that. But normally speaking, you need to do it in this period up here, 1st of July to 30th of September, and don't leave it till 30th of September. So it doesn't mean that you can't do it after those dates, but there is just a chance, and I know that it doesn't always get charged, but it may get charged, of the late payment interest rate, which HMRC, unsurprisingly with what's going on in the wider world, have just put up. So that is going to be 3%, until it changes again on that one. So just to be aware of that, really. Right, the very final thing I'm going to cover, just a quick note, you will all have seen headlines like this, I am sure, and be well aware of the national insurance rise that we have coming from the 6th of April. And then the following tax year going to be replaced by the health and social care levy. Lots of headlines about national insurance rise to hit middle income earners, the hardest 9% tax increases, big tax increases with the national insurance. All I'm going to say on that is don't forget salary sacrifice. Salary sacrifice has always been a great option because of the NI savings as well as your tax relief. It's just going to get even better because if you use salary sacrifice, obviously you'll be avoiding this national insurance hikes, which is going to become more and more valuable. So if you haven't got that on your list to speak to clients about, obviously, it's definitely one worth mentioning, where possible, exploring the options of salary sacrifice to avoid that hit. Right, quick summary then of what we've covered. Key points: anyone can pay into a pension. Providers might have their own rules, but In terms of getting tax relief, a bit really interested in, a member must have relevant UK earnings to get the tax relief, or they can pay up to 3,600 as a relevant UK individual. Someone else can pay it in, for example, an adult into a child, into a junior SIP. Employer contributions are not in any way linked to earnings. You've got the wholly and exclusively rules for tax relief. The availability of the annual allowance does not impact how tax relief is claimed. So always claim your tax relief, even if there's an annual allowance charge. Carry forward your unused allowance. It's not the tax relief. It is the allowance that's carried forward. Even if you're tapered, you can still carry forward a tapered amount. The taper impacts fewer people now, but they've raised the limits, but it's still complicated, and you still need to look back at those lower limits if you're using carry forward. Money purchase annual allowance is a reversible decision, but you can max contributions in the year that you trigger it, as long as if you make them before you trigger the MPAA. You have that double test in the year. Refunds of contributions, the only refunds are really likely if earnings are exceeded. They're the only excess contributions. Annual allowance charges may be able to be paid from the scheme. So we do offer voluntary scheme pays under all our schemes. For any annual allowance charge, if you want to use compulsory, there's much stricter rules. And that final point just about salary sacrifice is about to get even better because of the NI hike. I think I've talked for long enough for today. Thank you very much for your time. I hope that has been of interest, and goodbye.